And the first one you see says the bottom line of all investing is rate of return. And we believe that's in our DNA. And so everything we do about selecting an investment goes to the issue about how can we best understand what the rate of return opportunity is in that investment. We believe that whatever return the business has itself will be reflected in the share price over a period of time. We do some simple little arithmetic to reinforce that. Then when we find a business, we really focus on three issues, and in the shorthand, we've all talked about that, called the three-legged stool. Mm-hmm. And so the first leg is understanding exactly what the nature of the business is and what kind of returns on the owner's capital does it produce. And then we want to see if it has the ability to do that for a long time, if the runway is wide and long, we say. So what's causing that above average rate of return to exist? What's going on? What's unusual about that business? So the second leg that we look at is the people who run the business. And we're very focused on the skill level of the people who run the business and look at their record and whatnot. But we also want to know that they're acting in the best interest of all shareholders. That is, we see that what happens in the business happens to us on a per share basis. Mm-hmm. And then the last leg of it is the issue of reinvestment. So we examine how it is they have reinvested free cash flow in the past, what the outcomes have been, and they rarely break those out, by the way. We have to do our own work. And then what the opportunity for reinvestment going forward is, because the fact that they can reinvest all of their free cash flow to earn above average returns enhances our compounding effect. And that's what we're after at the end of the day. We want to compound our shareholders, our clients' capital at an above average rate while assuming a below average level of risk. And the below average level of risk piece for us has got nothing to do with volatility. It has to do with the fact that the businesses we own on average have more returns on capital, have higher growth rates, have stronger balance sheets, and very frequently have lower valuations than the market at the time we purchased them. So on their face, they have less risk than the market, than average. So
we aren't speculators in the price movement of shares. We own businesses. And the focus is on owning the most exceptional businesses that we can find. And if you're really limiting yourself to exceptional businesses, the list of businesses that you would ever own is going to be a short list. And that's why we're incredibly concentrated. And if you've identified a great business and you've purchased it well, why would you be in a rush to sell it? So the turnover is very low. We're not trading in and out of these names. And sort of lastly, it was very clear to me that Chuck didn't operate under a lot of these sort of institutional imperatives that a lot of money managers do in terms of diversification, in terms of willingness to hold cash. So in fact, I actually, before submitting my resume, watched an interview that Chuck did on television. I think it was in 2008. And he said at the time, I believe he was 35% cash. And whether being 35% cash was a good thing or not, what it said to me very clearly is that here's somebody who thinks and operates independently. So I found that very attractive.
And extraordinary companies.
Compounding machines.
The compounding machines, right. So why is it so hard to find those companies?
Well, they're scarce.
Yeah.
They have something unusual going on. And oftentimes it is not completely obvious as to what it is that's going on. A great example of that would be a company like MasterCard or Visa. Uh-huh. They're earning returns on capital that, as we say, you could cut in half twice and it would still be above average for an American business. So something extraordinary is going on there.
Right.
And the company does not talk about what that is. They never talk about it. We don't talk about it, but we spend a lot of time thinking about it, trying to understand what it is, whether or not it's likely to continue, that sort of stuff.
Why don't you like to talk about it?
I don't think we're giving away anything, but I just want to make sure we're not.
Okay.
It's just that simple, you know. And so the other side of that is a company like that earns rates of returns on the owner's capital that are so extraordinary that they don't have a good opportunity to reinvest their free cash flow in ways to continue to earn those above average rates. So what they do with their free cash flow is they buy in shares, they pay a cash dividend, they make small acquisitions in technology around their space, but it's a challenge to utilize all the free cash they generate. And unlike our ideal company is one that can keep reinvesting and earn outrageous returns on capital.
Right.